Welcome. You're here because you want to get straight to the heart of some key economic analysis, right? No jargon, just the essentials.
Exactly.
Today, we're doing just that. We're going to unpack Morgan Stanley's latest India Economics and Strategy report. It just came out, April 2025, and we're pulling out exactly what you need to understand from it.
Think of this as your cheat sheet, basically. This report, it's packed. You've got GDP forecasts, inflation outlook, what's driving the economy.
The risks, too, I assume.
Oh, yeah. Key risks, definitely. And crucially, what it all means for, different sectors, different investments. Our job today is really to filter all that down, give you the core insights, save you the time digging through it all yourself.
Okay, great. So context first. The report looks at India, obviously, but how does it frame that within the wider global economy? What's the big picture view?
Well, that's really the starting point.
Right.
They see India operating against a backdrop of a global economy that's, slowing down. There's quite a bit of noise around trade tensions, tariffs, that whole uncertain picture.
Right, the usual suspects. And how does that global slowdown feed into their view on India's own growth? Because I saw they tweaked the GDP numbers.
They did, yeah, just slightly. For fiscal year 26, they've nudged the GDP forecast down to 6.1%. It was 6.5% before. And it's a similar story for fiscal 27, now 6.3%, again, down from 6.5%.
So a little trim off the top, is there a point where they see growth being slowest?
They're pinpointing the last quarter of calendar 2025. They expect growth might dip to around 5.7% then, which is, a bit lower than the 6.2% they were thinking for the same period based on last year's view.
Okay. So why this slight downgrade, especially later on?
It seems mainly tied to expectations of weaker global manufacturing. That hits India's exports perhaps a bit harder than they initially thought.
Got it. So growth outlook slightly more cautious. What about inflation? That's always a big one. Any good news there?
Actually, yes. The inflation outlook seems, pretty benign is the word they use. They're forecasting an average inflation rate of about 4% for fiscal 26.
Just 4%.
Yeah, and maybe even better, for the calendar year 2025, they think it could actually dip below 4%. A lot of that is down to softer food prices, lower oil prices, too.
We've seen oil come off quite a bit.
Exactly. And current core inflation that's stripping out food and energy, it's running at about 3.8% year on year for the last 3 months. Now, that is up a bit from the low point last May, which was 3.1%, but the overall trend still looks pretty contained.
And below 4%, that potentially gives the Reserve Bank some breathing room, doesn't it?
Absolutely. It could definitely give the RBI more flexibility on, thinking about interest rates without worrying too much about prices taking off again.
Okay, that's positive. Now, with this global slowdown talk, are they worried about India actually tipping into recession?
That's a key question, isn't it? No, they're not forecasting a domestic recession for India. That's important. But they do flag that the risks are tilted, downwards, mostly because of that potential for a sharper global slowdown.
Especially the U.S.
Right. They mentioned the U.S. specifically. If the U.S. were to enter a recession, which I should add is not their main forecast, but if it did, that would definitely put a dent in India's growth.
But India has strong domestic demand, right? Does the report weigh how much that could shield us?
It does touch on that. The domestic story offers resilience, for sure, but the report implies that a really sharp global downturn, it would inevitably have some negative impact. You can't fully decouple.
Okay, makes sense. Cautious, then, shaped by these global currents. Let's dig into the specifics now. What does the report see as the main engines actually driving growth in India?
Well, despite those global trade headwinds we mentioned, they see improving consumption within India as a really key positive. That's being helped by better demand coming back in rural areas, which is huge for India, of course, and also government spending kind of normalizing after some belt tightening.
Right, the domestic engine kicking in. And we mentioned lower commodity prices helping inflation. How big a factor is that overall?
It's pretty significant.
Yeah.
Lower food prices, and especially oil, you mentioned it being down, it's like 22% year to date. That really takes pressure off inflation. And like we said, that potentially paves the way for the RBI to perhaps adopt a slightly easier monetary policy stance, loosen things up a bit.
Interesting. Easier money could definitely help. They also mention a potential U.S.-India trade deal. Is that seen as a major potential boost?
It could be, yeah.
Yeah.
If you think about the global trade friction, a solid U.S.-India deal could be a big counterweight. The report mentions this goal, you hear it sometimes, of hitting $500 billion in bilateral trade by 2030.
Wow, $500 billion.
Yeah, I think it's ambitious. But getting anywhere close would obviously be a huge plus for India's exports
Yeah.
and could offset some of those tariff issues elsewhere.
Okay, some decent rivals there. Now let's flip it. What are the main risks? What could knock things off course? We know about the global slowdown risk. Anything else major?
Absolutely. That risk of a deeper global slowdown is number one, really, especially if the U.S. slows more than expected. Morgan Stanley is actually only forecasting about 0.6% growth for the U.S. in Q4 2025.
Just 0.6%. That's pretty sluggish.
It is. So if it's worse than that, it clearly hits demand for Indian goods and services.
What about money flowing in and out? Capital flows. Always a sensitive spot.
Yeah, that's flagged up too. Volatility in capital flows is a concern. They note the FII equity outflows foreign institutions pulling money out of the stock market. That's been around, what, $27 billion since September last year?
That's quite a chunk of change.
It is. And at the same time, FDI, foreign direct investment, has been a bit sluggish,
Yeah.
running at about 2.1% of GDP. So put those together, and it could make funding India's current account deficit a bit more challenging.
So outflows creating short-term wobbles and maybe slower FDI suggesting less long-term confidence?
Kind of, yeah. The FEI flows can definitely stir things up in the markets short term. And ideally, you want to see stronger FDI for that long-term investment confidence.
Okay. And one more risk they mentioned. Something about the rupee getting stronger. How is a strong currency a risk?
Yeah, the real effective exchange rate. It's a bit counterintuitive, maybe. But if the rupee gets too strong, adjusted for inflation against other currencies, that's what RER measures, it basically makes Indian exports more expensive for foreign buyers.
Ah, I see. So it hurts competitiveness.
Exactly. It can make it harder for Indian companies to compete on price in global markets. It's always a balancing act, you know.
Yeah.
Too weak isn't good, too strong isn't good either.
Understood. Okay, that gives us a good handle on the forces at play. Let's switch gears now to what this all means for markets and investments. Equities first, the stock market. They've changed their Sensex target.
They have, yes. They've lowered the December 2025 target for the Sensex down to 82,000.
82,000. How does that compare to before and to now?
Well, it's about 12% lower than their previous target, which is quite a cut. But importantly, it's still about 9% higher than where the market is roughly right now.
So lower expectations, but still expecting some upside. What's driving the cut? Global uncertainty again?
Mostly, yes. It reflects those global headwinds we've been talking about. And related to that, they've also trimmed their earnings forecasts for companies.
Okay, how much?
They've cut their earnings estimates for fiscal year 2026 by about 13%. Again, largely down to those global factors potentially hitting company profits. But, and this is a key but, they do stress that they think the medium-term earnings cycle in India still looks basically intact, still fundamentally sound.
Right. So near-term bumps, but the longer road still looks okay. What about specific sectors? Where do they see opportunities and where are they cautious?
Okay, this is interesting. They're recommending an overweight position, meaning hold more than the benchmark in financials, consumer cyclicals, and industrials.
Why those three?
The thinking is these are the sectors best placed to benefit from that domestic growth story we discussed and also from any potential interest rate cuts from the RBI.
Okay, makes sense. And the underweights, where are they suggesting caution?
They're underweight on energy, materials, utilities, and healthcare. The view there is these sectors are more exposed, more vulnerable to things like falling global commodity prices and weaker export demand.
So a clear preference for domestic-facing sectors over globally exposed ones?
Very much so. That seems to be a core theme running through the strategy part of the report.
What about company size? Small caps, mid caps have been very popular. Are they still keen on those?
This is a notable shift. They've moved to what they call a capitalization agnostic stance.
Agnostic.
Meaning they're not really favoring small and mid caps over large caps anymore, or vice versa. It's more balanced.
Why the change? Is it about safety in uncertain times? Large caps being more stable?
That seems to be a big part of it, yes. In a more uncertain global environment, the resilience of larger established companies might be more appealing. It probably reflects a bit of both, maybe some concern about smaller companies' resilience, but also seeing value in the stability of large caps right now.
That's quite a change from the recent trend, isn't it?
It is. So what's the overall investment approach then in this kind of market?
Well, they're really emphasizing that it's becoming more of a stock picker's market.
Meaning you can't just ride the wave.
Pretty much. Just buying the index or following broad trends might not cut it. The focus needs to be on finding individual companies, specific stocks, that can outperform, generate that alpha, as they call it.
They also make an interesting point about India's beta.
Right, its sensitivity to global markets.
Exactly. India tends to have a low beta, meaning it's generally less volatile than global markets overall. So during global sell-offs, India might hold up better, might outperform, relatively speaking.
But the flip side is,
The flip side is, even if it outperforms relatively, the absolute returns might still be capped if global markets overall are weak. Outperforming in a falling market still means you might lose money, just less than elsewhere.
right, understood. So focus on stock selection within those favored domestic sectors. What about other assets? Bonds? Commodities?
On fixed income, or bonds, the outlook seems potentially quite positive. With inflation looking benign and the expectation that the RBI might cut rates further, that generally means bond yields could fall.
And falling yields mean rising bond prices.
Correct. So that could make fixed income look relatively attractive.
And commodities. We know prices are down.
Yeah, it's a bit of a mixed bag there. Lower prices for things like oil and metals are good news for companies that use them as inputs, lower costs. But for companies in those commodity sectors, the ones actually selling the stuff, lower prices obviously hurt their revenues and pricing power, especially in tradable sectors.
Okay, so it depends which side of the commodity equation you're on. Let's talk policy response. What do they expect from the RBI, the central bank? More rate cuts.
Yes, that's the base case. They're forecasting 2 more rate cuts, 25 basis points each, sometime in the rest of 2025. That would take the total cuts in this cycle to 100 basis points, or 1%, bringing the main policy rate, the repo rate, down to 5.5%.
And if things get worse, if growth really falters,
Well, they suggest the RBI has more tools. They could potentially inject more liquidity into the banking system, or maybe ease some of the macroprudential rules to encourage banks to lend more.
okay. And what about the government? Fiscal policy. Are they expected to keep tightening the belt?
The expectation is yes. The focus on fiscal consolidation, reducing the budget deficit, will likely continue. They note the recent fuel tax hike that RS2 per liter on petrol and diesel will help a bit on the revenue side. About 0.1% of GDP, they estimate.
But what if the economy slows down more sharply? Would they pause the consolidation? Maybe even spend more?
That's the risk, or the potential alternative, they point out. If the slowdown really bites, the government might have to pause the deficit reduction plans. They might even decide to increase public spending on infrastructure, say, to try and boost demand.
A bit of a balancing act there, too. Finally, on policy, any comments on trade policy direction?
Just that some recent moves, like simplifying customs tariffs and getting rid of that equalization levy, the Google tax, suggest India is perhaps more willing now to engage in trade talks and potentially sign deals.
Especially with the U.S., perhaps.
That seems to be the implication, yes.
Okay, fantastic. That's a really thorough walkthrough of the report. So let's try and boil this down for you, our listener. What are the absolute key takeaways you should have from this Morgan Stanley analysis?
Right, the bottom line. I'd say the main sentiment is one of cautious optimism. India's domestic strengths are real, and they could help it do better than many other markets right now. But those global uncertainties are going to act as a brake, likely limiting the overall upside.
So be selective, and where should that selection focus?
The report strongly suggests focusing on those domestic-oriented sectors: financials, consumer cyclicals, industrials. They're seen as best placed for the domestic recovery and potential rate cuts. And within that, like we said, it's probably a good time for careful stock picking to find those potential outperformers, that alpha.
And keep an eye on.
Definitely keep an eye on the U.S.-India trade situation. A good deal there could be a real positive catalyst. And also just be mentally prepared for potential negative surprises from the global economy. They could happen, and they could prompt further action from the RBI or the government here.
But the long-term picture.
Despite the near-term clouds, the underlying story for India still looks pretty positive long-term. Things like, rising equity ownership, the potential for private investment to pick up eventually, demographics. These factors still support a decent outlook for earnings growth down the road.
Great. So to wrap it up for you, the global picture means expectations for India are a bit more tempered now, but this report highlights real domestic strengths and specific sectors that might be worth your attention.
Which leads us to a final thought for you to mull over. Given all this, what specific bits of the Indian economy, or maybe those global trade dynamics, feel most important for you to watch in the coming months? How might these adjusted forecasts influence your own thinking or decisions?
Something to consider. We hope this deep dive gave you a clear, efficient understanding of this important analysis.
And we can definitely revisit these themes as things evolve. Thanks for tuning in.